My name is Scott Mazuzan. I'm a certified financial planner and a client advisor at F.L.Putnam Investment Management Company. I've been with the firm since 2011. I'm a Maine native and bounced around a little bit in the years after finishing my undergrad, but have been back in the Portland area since 2011 and then with the firm since that time as well. My colleague Jill, who's on the line as well, is a certified financial planner and client advisor at F.L. Putnam, and is also a Maine native who bounced around a little bit and found her way back here to Maine, as many people do. Jill and I have the same role at F.L. Putnam as client advisors and financial planners. Our job is to work with clients on all the areas of their life that touch money, that might not be directly, their investment accounts, their stocks and bonds. Rather, we're talking with people about plans for retirement and questions about Social Security, taxes, insurance, estate planning, etc. So the work we do touches a lot of different areas, overlaps quite nicely with a lot of the conversations we have with our clients on a regular basis. So that's one of the reasons why Linda thought to have us come and chat today. As roots in New England, we've been based in Maine and Massachusetts since the 1980s, but in recent years have grown considerably with a presence all around the United States. Um, we have about $10 billion under advisement, with 8 billion under management and 2 billion um, advised, and we provide a wide variety of services from portfolio management and investment consulting to some of the more financial planning focused services that we'll be talking about today. Our clients are individuals and families, like many of the folks on today's call, probably, but we also work with nonprofits, endowments, and churches and scholarship funds and that sort of thing. So we get the chance to get engaged with all sorts of communities. We're about 130 employees in 16 different states, but like I said, heavily focused in the Northeast. So why are we here today? Um, Making your money last in retirement. A very common question that I get and that Jill gets and a lot of our colleagues get when meeting with clients is, how can I be sure that, and I think Linda said this, um, I can't remember how she phrased it, but I don't want the portfolio to run out before I do. Um, you don't want to run out of money while you still got time left on the clock. And as you can imagine, this is a fairly complicated uh, exercise to try and figure out how to thread the needle. Um, we try to break it down into somewhat digestible pieces, so that we can talk about it with clients and problem solve and do some testing to see that things will work. And I'll dig into that today. Um, but I just wanted to give you a sense of what we'll talk about here. First of all, we'll talk about how to stretch that portfolio out. So that's usually broken down into sort of three phases of thought or um, modeling exercises. That's taking inventory of what you have, um, putting together a paycheck for yourself, and then performing some basic stress testing or modeling. Um, Beyond that, I'm also going to share a few words and some thoughts about um, constructing your portfolio and your asset mix, and the ongoing management of your money throughout retirement. A lot of folks ask, well, now that I'm retired, how should I invest my account or how should I set up my funds? And that's something I'll spend some time on at the tail end of the presentation today. So lots to cover, and again, because it's a pretty interesting topic, and I could speak for an hour on any one of these bullet points. Please feel free to add questions in the chat, and we'll do our best to get to everything. So the phase one of the make your money last endeavor, I call it taking inventory. And it's just basically giving yourself a lay of the land as far as figuring out, your pool of money, the resources available to you, and the ways in which you hope or need to spend those resources. So step one, we want to look for all of your sources of income now and in retirement. For many retirees, the primary sources of income are Social Security. Pensions have become less common these days, but there are still folks out there with pensions from their employers. Um, Other folks have trust or business distributions, real estate income, and then, of course, there's employment income. So whether that's your career or a lot of folks choose to work into and throughout retirement um, on a part-time basis, or maybe something completely different. So instead of a career in advertising, for example, maybe working 3 days a week at the hardware store mixing paint. So that's something we see quite a lot of. In any case, um, step one, identifying those sources of income that you expect to receive throughout retirement. Step two, take an appraisal of your assets. So again, I'll say a few times today, I consider this kind of your pool of money or your bucket of money, and we want to know exactly what's in that bucket. So first of all, your liquid assets. So this is the money that you'll be spending and using to cover living expenses above and beyond what your income can take care of. Things like brokerage, investment accounts, bank accounts, money markets, CDs, 401k plans or 403b plans, IRAs, all of the, sort of investment or bank accounts that you might have floating around out there. Beyond that, it's also important to get your arms around, that the more illiquid assets you have on your balance sheet, because those may be sources of liquidity someday, or they may be something that you hope to hang on to. But that's things like real estate, business interests, partnerships, and so on. And then finally, if there are other valuable assets, um, family heirlooms or valuable artwork, um, it's also important to include that in your planning as well. Finally, we want to be pretty clear-eyed about expected expenses in retirement. And I avoid the dreaded B word, budget, because that makes a lot of people recoil from this exercise. But um, it's really important to get an idea of what your needs, wants, and wishes are. So starting with your non-discretionary expenses, including any debts that you have and that you need to service, the things that you must pay for every month, no matter what. Layering on top of that, looking at discretionary expenses, things like entertainment, dining, um, media, the things that you do for fun. Um, and then we look for, one-off or recurring other type expenses. Examples I usually use for this are car replacements, home improvements, helping pay for a child's wedding, um, travel costs every year, that type of thing. And then finally, the sort of scenarios that might keep you up at night or scenarios that you might get excited about. Um, Things like, well, what if I have a long-term care event and I need healthcare for a long time? Or what if I want to downsize or move to a retirement community? Or what if I inherit $1 million out of nowhere? That's the one I think most of us hope for. But creating these what if scenarios are going to help us later on when we start to try and stress test a little bit beyond covering our basic expenses. So that's phase one, taking the inventory. And with that being done, um, usually this is a good opportunity to perform a quick gut check and say, okay, I've got a sense of my income in retirement, and I have a pretty good sense of my expenses. So how far am I uh, along the way of getting those expenses covered? How close am I to meeting all of my needs? And what's the gap there? And filling the gap is the job of your savings. So whatever you've tucked away over your lifetime in retirement or savings accounts. Um, and this is just the first crossroads and opportunity to, you know, figure out how big the gap is and start to think about um, how to fill the gap. With that in mind, we get to phase two, which is putting together that retirement paycheck, as I like to call it. So a lot of folks will try and consider cash flow on a monthly or biweekly basis. Um, this is a really tough transition for a lot of people, a lot of clients that I've worked with over the years, as they stop working and enter retirement years. Having spent a lifetime saving money away, and planning for retirement and putting extra in the piggy bank, to suddenly flip the switch and reverse the flow, so to speak. It's a really tough mental hurdle to get over, and I don't want to understate that. So the fact that you're giving this any thought today is a big deal because this is a challenging effort. Um, so as you might imagine, in putting together your retirement paycheck, step one is the retirement income creates a base. So that's your Social Security, your employment income, pension income, whatever the case may be. And then, like I said, filling the gap with supplemental portfolio withdrawals. So that's taking money out of your accounts, whether it's a savings account or a retirement account. Um, Now, the rate at which we take withdrawals from our savings should be informed by testing and modeling, and I'll talk a little bit more about that in a minute. But keeping good track of what you're withdrawing, um, whether on a scheduled basis or on an ad hoc basis, is really important for evaluating your withdrawal rate on an ongoing basis and understanding year over year, how quickly am I drawing on this nest egg, and is that going to be sustainable over the long term? Um, so the big question that we get now after we've kind of figured out with clients, what's the gap and how much do we need to fill, um, is in what order should I draw from my accounts? I know there were a number of people on today's call who were interested in hearing um, about this question. Um, so the important caveat that I always start with is that every person's situation is unique, certainly, but there are general rules of thumb or orders of operation that a lot of folks default to, which I'll get into. But first, a quick word about retirement accounts and required distributions, for those who might not be familiar. Retirement accounts, for the most part, will, at a certain age 73 or 75, depending on when you were born, uh, you will be required at that age to withdraw a certain amount of money from the account each year, and it's calculated by the IRS based upon the prior year's market value and your life expectancy. Um, and that minimum amount increases gradually over time. Um, and so the required distributions are off on the horizon for a lot of retirees. Um, and I'll talk about that a little bit later on, but I wanted to mention that. I also want to just explain the term tax shelter in this context. Um, an account like a retirement account is often described as a tax shelter because the growth that happens, the capital gains and the dividends and interest that happen inside of that retirement account are tax-free, which really kind of proliferates the growth happening in that account because you're not paying taxes on the growth. Um, So there's sort of a general mindset, and this gets into the order of operations that of withdrawing from accounts, which is the default guidance of let's delay taxation by preserving those tax sheltered assets as long as possible, meaning only take out the minimum from your retirement accounts, um, and only do that when you're required to do it. Um, in that way, you're first tapping your other accounts. So your brokerage account, your bank account, your savings, your CDs. Um, and in doing that, you're allowing the retirement accounts to continue growing away inside the tax shelter. Furthermore, you're delaying some taxation because money that comes out of most retirement accounts is treated like ordinary income, as if you were um, collecting wages. While on the other hand, withdrawals from uh, after-tax accounts do not get treated as ordinary income. Um, they they are subject to capital gains and um, income tax on the growth along the way. But for this reason, it's usually much cheaper today to get money from a after-tax account than it is to get that money from a retirement account. So step one is always those after-tax accounts, and then dipping into the retirement bucket, and then finally Roth accounts last. Roth IRAs are kind of like the golden goose of retirement accounts because they have the tax shelter, which I described earlier. They're never subject to required distributions, um, and withdrawals are tax free. So because they're pretty special accounts, and because it's kind of hard to get money into Roth IRAs for a lot of earners, um, the general guidance is, leave those things alone as long as possible so that they can really grow. Um, and because it's also hard to get dollars into there. Um, so this is the sort of generic order of operations that most advisors will default to when their clients ask, which order should I use when dipping into my funds? Now, like I said, everybody's situation is somewhat different, and there are a lot of circumstances that would call for, maybe a different approach to this. Some folks may not have substantial balances in after-tax accounts to cover living expenses in early retirement. And so that means, waiting until required distribution age might not be realistic. Um, Other folks are hoping to take advantage of, lower current tax rates, maybe if they're in their pre-required distribution and pre-Social Security years. They're thinking, well, I have really low income right now, so let me get some of those retirement dollars while I'm in a really low tax bracket. And there are some other sort of um, uh, niche or technical situations which might call for a shakeup. But um, the general rule is, there's this blueprint that's out there, and it's incumbent on folks to think about their own situation and their needs, and work with their advisors or do research on their own to determine which order of operations works best for them. Um, Finally, having put together um, a retirement paycheck for oneself, filling the gap, putting all the pieces together in terms of assets and income, it's important to take a look at things from a mathematical or statistical perspective. And I know those are not everybody's favorite words, but we want to make sure that the rate at which you are supplementing your income with withdrawals is sustainable over time. Um, the two major determinants, and I'll visit this theme a couple of times today, but the major determinants of portfolio longevity are your spending levels, so how much money you're taking out of the account every year, and then the investment growth that the account enjoys over time. Um, Spending levels, if for example, if you withdrew 20% of your account every year, it wouldn't take too long for you to deplete that account. Whereas if you were taking 3 or 4% every year, um, it would last much longer, and depending on the growth rate of the assets, could last quite a long time. Um, so we use a set of tools, often referred to as goal-based planning, um, to explore how feasible it is to support certain living expenses or certain financial goals in the context of all of the assumptions that we put together, in these previous phases, the inventory of assets and income and the outline of expected expenses. There are a lot of tools that we as advisors use, that are, a little more technical maybe than are required for the basic endeavor. There are also a lot of tools available to folks who are trying to do it on their own, whether it's, a simple Excel spreadsheet or online tools available through Empower, Bankrate. Both have good retirement calculators, and any number of other free or, low cost um, retirement calculators that are out there on the web. Um, this is also a good opportunity to start thinking about what your portfolio longevity goals are. Are you hoping to preserve principal? I want to keep the value of the account level and make sure that my kids or some other beneficiary receive a certain sum, or are you looking more for a sustainable glide path down, where you're not necessarily spending every last dollar, but you're not on a worrisome trajectory. So we have two, well, first of all, visualizing this is always helpful for me and helpful for a lot of my clients. And like I've said before, I think about the assets as a pool or a kind of a bucket of money, and the appraisal of assets is kind of figuring out what the level of the water is in that pool. Um, there's a faucet over the pool, and into the water is flowing Social Security, employment income, pension income, and so on. So that's great. It's bringing the water level up. But in the meantime, there's a big drain at the bottom, and out of that drain is coming your expenses, your wants, needs, and wishes. So it's really the rate of change of the level of water in this pool that is the crux of what we're looking at here, trying to determine if this thing's going to run out of money, um, before we're at the end of our lifetime. So the first and very basic way to think about that is to take all of the information we know about income, expenses, and assets, apply some simple assumptions about how much we expect our account to grow or appreciate in any given year, and say, like if you pictured it on a spreadsheet, starting balance, apply some growth, apply the expenses by deducting an amount, and then you have kind of an ending value. And that's what we call straight line or cash flow projections. And this visual you see on your screen is an example of a straight line projection, with a certain set of expenses and assets, and assumptions, and each blue bar represents, somebody's portfolio value at the end of a given year, or basically a quick read on, how much water is in that pool of money. This is a great, straightforward, easy to conceive way to think about things, and it can give you a good directional sense of, hey, it looks like I'm on a pretty shallow path here. I've got 20, 25 great years. Um, or if conversely, if it's really steep and going down to zero, um, then that's a little more worrying. Or if it's staying flat or going up, then that's maybe a cue that you need to take a couple more vacations. Um, but some of the weaknesses are that, of course, as many of us know, there's really no such thing as an average year, especially not any such thing as 25 average years in a row. And so the order in which, um, you know, if you have bad markets and then good markets and then bad markets, the order in which those years happen can make a big difference for people. Um, so we have another approach that we call Monte Carlo stress testing. This is slightly more nuanced and calls for more statistical inputs about growth rates, standard deviations, and how asset classes behave relative to each other. So stocks go up and bonds go down and that kind of thing. Um, but importantly, what this methodology captures is what we call the sequence of return risk, or that thing where, a bad year in the markets right in the first year of your retirement is bad timing, and that could be damaging. Um, so the way that the Monte Carlo illustration works is, instead of just applying an average return every year, the software will randomize the sequence of returns year after year after year. Um, and so you end up with something that looks a little less predictable. Um, and the illustration doesn't stop there, though. It continues along and does this, 1,000 times, so that you end up with a range of different outcomes with a concentration or clustering around an average. And the average will look a lot like, those blue bars looked a few slides ago. Um, But what we're really looking for is, in all of those different simulations with really crummy markets and really strong markets, what percentage of the time are we successfully funding all of these spending goals, um, without hitting the zero line on the dollar amount. Um, and so that's a really, more nuanced way to look at things. Um, this captures that sequence of return risk that I talked about earlier, and it's a little more robust than, just applying a straight average every year. But as you may gather, in this quick summary, it's a little harder to conceptualize. It usually requires a more involved software, and so may not be as readily available on some of the free tools online. Um, the point is, with both of these efforts, is that, um, none of these are prescriptive or guaranteed, but they provide really helpful context for, taking all of the assumptions that you have, all of the knowledge that you have about your assets and income, and how much you're hoping to cover, with your accounts, um, and really identifying the guardrails, or where the tipping points or sensitivities are, for, that line being too steep down to the right, or staying level. It also allows you to take some of those what if scenarios that you came up with earlier, and throw those in, and see, well, it actually doesn't look so bad, or hey, it looks like it's pretty realistic for me to make the move to the retirement community. Or, oh, it looks like maybe I need to dial back my withdrawals a little bit in order to kind of make this thing a little more even. Um, it's also really helpful, I've found, in times of duress. So when the market's really ugly, or when people are having big expenses, to come back to these models and revisit some of the plans we've put together and say, oh, even though we had XYZ, um, I'm still in pretty good shape. Um, so that is kind of the third leg of the stool when it comes to this, putting together your retirement income, and then ongoing sort of diligence to make sure that what you're doing in filling the gap, quote unquote, is sustainable over the long term, um, regardless of what your goal is for, um, preserving principal versus drawing down gradually. Um, just a few more words on, um, portfolio construction, managing your money in retirement, and then we will go to Q&A. But like I mentioned before, the two major levers you can pull, for determining how long your assets can last. One is spending, and we've talked about that, and the other is investment growth. Um, Investment growth is related directly to the level of risk, that you have in your investment accounts or in your savings accounts. Um, the term asset allocation we use a lot, and that basically refers to the mix of growth assets, which are higher risk, higher return, things like stocks, um, and the mix of those with, income producing assets or lower risk and lower return assets, things like bonds and CDs and money market funds. Uh, and the mix of those things together make up your portfolio on the whole. A higher allocation to risk means that you will have higher average annual returns in most cases. Um, in return, you experience more volatility. And so there are a lot of considerations for that, but over the long term, a higher risk allocation will mean higher returns, and similarly, a lower risk allocation means lower returns. Um, Figuring out what the right asset allocation is kind of tricky. A lot of folks come to us and say, "Well, I've retired, so it's time to go low risk, right?" And a lot of people are familiar with the concept of kind of de-risking their portfolio over time, and we feel, yes, it's totally appropriate to reduce your risk over time. You have to honor some of the factors that make that appropriate, like a shorter time horizon or a lower tolerance for risk. But there are a lot of factors that go into figuring out the right asset mix. Time horizon is a big one, and because people are maybe retiring earlier and life expectancies are longer than they were for our parents and grandparents' generation, um, you know, switching to all low risk assets right at age 60 or 65 um, might not be the right move because you might have 20, 30 years if you're going to live to your 80s, 90s, or even 100s, um, you know, several decades of expenses to cover. And that might call for higher levels of growth in the account so that you can support those expenses. Other factors include liquidity needs. So what kind of cash do you need right out of the gate? If you have big expenses early on, then you're certainly going to want to reflect that in your portfolio composition. Um, your spending levels. So if you have high spending needs later on, then certainly you have to think about preserving some risk assets. Your ability to tolerate risk. Even if you need a higher allocation to stocks, if the volatility of owning stocks is going to be too stressful and it's going to lead you to make market timing mistakes or do something rash, then that certainly ought to be considered as well. So there are a lot of things that go into the asset allocation decision on an ongoing basis. And so we encourage people to think about all of those things rather than just thinking, well, I'm retired now, so that means I go 100% to bonds. And that's a good segue to, kind of the last quick topic I want to cover, which is how do we contextualize, these withdrawal uh, policies, these spending numbers or what we're taking from the account against the growth rates that our portfolios experience in retirement years. And there's an old kind of um, mindset that I referred to earlier, which is in retirement you can just go 100% to bonds. And on the screen here, you can see a picture of an old savings bond um, with little coupons on it, and you would just clip off the coupon and take it to the bank, and you get your interest payment. Um, and so there's a mindset of, well, if I just get my portfolio set up, I can focus on those interest-bearing or yield-producing investments, and I can just live off whatever income, whatever dividends or interest income is generated and preserve the principal. Um, that's a great basic approach, and it's very easy to kind of conceptualize and think about. But the challenge for that has been certainly in the last 30 years or so, we've been in a steadily declining interest rate environment. So it has gotten increasingly difficult to live off of the income alone that's being produced from portfolios. And certainly after accounting for inflation and taxes, it's hard for the spending power of your money to keep up if you're only investing in low risk or income producing assets. generally speaking. And so that leads me to, this kind of 4% rule that a lot of people have heard about, which is predicated on a total return approach to thinking about um, portfolio growth and what kind of withdrawals that allows. If you think about the term balanced portfolio, which you hear a lot, we're commonly talking about an asset mix of about 60% stocks with the balance to bonds and cash. Um, and an account set up in that way, on average, over long periods of time, will experience a growth rate, a total return in the high single digits range. And that's a blend of not only the income that is generated by the assets, but also the appreciation, so the value of the investments increasing over time. Um, so if you take a 6 or 7% portfolio return and then back out 2 or 3% for taxes, fees, inflation, um, you're left with about 4% that you can spend and still not touch your principal. Um, and using the law of large numbers and these kind of average returns over long periods of time, this 4% rule has worked really well for a lot of endowments and nonprofits that have a mandate to preserve principal um, in perpetuity. So it's a great, again, a great directional tool for retirees to think about, spending about 4% of my account each year is sustainable because, you know, if I have a balanced account, I know I'm experiencing at certain average growth rates, and despite ups and downs, you know, over the long term, it's been shown that this ought to preserve the principal value of the portfolio over time. So that's kind of the genesis of the 4% rule. And thinking about things from a total return perspective has become more essential for retirees in the current environment when, um, with the exception of the last couple of years, interest rates have been really challenging for investors. Now, we've had higher rates, higher than recent history in the last couple of years. So it's actually been a little bit easier for folks to own bonds or CDs or um, savings accounts that generate the level of income that you might be able to live on. But with the Federal Reserve cutting rates now, we expect those rates to fall. So this is a challenge, a dynamic that retirees will continue to face, and it just speaks to the need to have, a thoughtful and dynamic approach to, how you position your retirement assets. So obviously, I've thrown a lot at you here, but the conclusion I think is really just honor the unique elements of your own situation, and just think about a few best practices that will help you kind of contextualize the longevity goals that you have for your assets. First, set a spending goal. Be real about what you need to cover your expenses. Second, have a really good inventory of what you own and what kind of income you can expect. And finally, to the extent possible, whether you're doing it on your own or working with an advisor, perform some kind of stress testing to make sure that the rate of withdrawal that you're taking is sustainable over the long term. Um, and I've gone a little bit over time, so apologize for that. But um, I'm not sure if there are any questions that haven't been answered in the chat. Um, Jill, are
Yeah.
you?
Yep. So there's a question here, Scott, about annuities.
Hmm.
What role, if any, do annuities have in retirement planning, and
Yeah,
what types should be examined and what types avoided?
yeah, that's a great question. And I meant to mention annuities earlier. Um, there are a lot of different kinds of annuities out there, so I can't speak to everything. But generally speaking, there are some annuity product, and for those who aren't familiar, an annuity is sort of a mix of an investment vehicle, and an insurance vehicle. And so usually there's some element of, your assets appreciating and some element of an income guarantee or a cash flow guarantee. Um, so with that being said, I encourage people to do research um, about the different types of annuities. There are some out there that are very expensive and have a lot of kind of fees, commissions, incentives built in for the folks that are selling or distributing them. Um, um, and as far as the role that an annuity can play in retirement planning, there are some annuity products which are very straightforward. You pay a single premium and they will give you an immediate income stream for life as long as you live, or for your life and a beneficiary's life, or any combination of those things. And in situations like that, it can be valuable for some people to have, an additional stream of guaranteed income rather than taking that same money and investing it and working with a total return mindset. Um, so, an annuity in its true annuitized form with a guaranteed income stream factors into the appraisal of your expected income discussion. There are other annuities that are seen more as investment vehicles with special uh, income benefits, and tread carefully there. They those will have appreciation capability, and should be kind of approached as hybrid investment insurance vehicles. I I'm hesitant to say what to avoid because I don't want to cast too wide of a net or make any generalizations. But I would say just be very cautious about fees and make sure you're asking about incentives and some of the insurance charges. Um, and be sure to always compare that to, what you could accomplish in a balanced portfolio of low cost uh, mutual funds or exchange traded funds.
And here's another question. Scott, what's your recommendation on starting Social Security income at 62 versus waiting?
Yeah, another great question. Um, so for those who don't know, Social Security retirement benefits can begin as early as age 62 or as late as age 70. Your own personal quote unquote full retirement age depends on the year in which you were born. But that's the benchmark age that kind of defines your baseline benefit. It's usually around 66 or 67. And the earlier you collect, the lower your monthly benefit. The later you collect, the higher your monthly benefit. And so most of the literature out there, most of the articles and podcasts, they'll say if you wait until 70, you get a guaranteed 8% um, return because every year you wait, your benefit goes up by 8%. And that's a increase in your lifetime benefit forever. Um, and that's great. So, in a lot of cases, it's really good and beneficial for folks to wait to get that extra income either for themselves or for a survivor if something should happen to them. But again, it's a little nuanced and very personalized because if you've retired at age 60 and you don't have an awful lot of savings um, or retirement assets, um, delaying until 70 might not be realistic because it could force you to withdraw more from your accounts than is sustainable. Um, Furthermore, if you have a family health history that suggests that um, longevity is not in the cards for you, um, the waiting to collect your benefit, um, there's a break even point where it takes a certain number of years of collecting for you to kind of catch up to the version of yourself that collected early and then get ahead. So usually that happens in someone's early 80s. And, a lot of folks might not expect to live quite that long. So there's a real kind of trade-off when you think about, the risks of waiting versus collecting early. I mean, certainly if you can afford to wait, it's a great way to boost your eventual guaranteed income. But there are a lot of factors that go into it, which is kind of my throwaway line for the day. But um, you should think about your personal circumstances and um, how the decision to wait might play into your cash flow. We try to perform a portfolio review with our clients once a year. A lot of folks are really kind of dialed into their accounts. If you're a do-it-yourself saver or investor, um, chances are you've got the app on your phone, and you're looking, quite often. But we like to perform at least annual reviews, and with the stress testing or modeling, um, you know, annually, or maybe less frequent if you're kind of in a trend, and um, not a lot of changes and markets are going up. But sometimes people will update those more frequently. But it's good to stay engaged with your accounts and your investments. And if you're doing it yourself, probably more frequently than annually. You'd want to be monthly or quarterly taking a look at things to make sure nothing's out of whack.